So every trader is looking for that strategy that is guaranteed to work. It's the strategy that has positive expectancy, meaning that as long as you do it enough times, do it with enough occurrences over time, you're guaranteed to make a little money. And we're all looking for that. And as options traders, we're definitely looking for these strategies that have a positive expectancy, these strategies that have an edge that we're practically guaranteed to make money on as long as we do this strategy over and over and over again. And one of these very profitable strategies is selling put credit spreads in SPY. So guaranteed profits with SPY put credit spreads. And today I'm going to be showing you a basic options trading plan. We're going to set some parameters, some rules on how we're going to campaign trade SPY put credit spreads. And the rules that I lay out in this trading plan on this video today, we've actually been trading these exact same SPY put credit spreads in the DT Options Discord server. Every week or every 2 weeks, we've been putting on these SPY put credit spreads, and they've actually been printing a little money for us. We've been making a little money, and we've back tested these SPY put credit spreads, and we know they have a positive expectancy as long as we keep trading these. So one of the reasons that put credit spreads do well in SPY is because SPY, which is the S&P 500 ETF, and the S&P 500 is essentially a proxy for the broader overall stock market. And the overall stock market tends to go up over time. It has what we call a positive drift, meaning it tends to go up over time. And it's that positive drift that makes SPY such an attractive investment vehicle for those of you that want to do long-term passive investing. Just buying and holding shares of SPY is a fantastic strategy. And for those of us that want to actively trade with options, for example, pretty much any bullish option strategy should do very well on SPY because it tends to go up over time. And conversely, any bearish strategy is not going to do that well in SPY. So knowing that bullish strategies work well in SPY, the obvious choice of a SPY strategy would be the short put. You just sell naked puts in SPY and you should do exceptionally well. And in backtesting, short puts are probably the best trade you could make on SPY, but there's a problem with short naked puts. Not everyone can trade naked puts on a product like SPY because SPY has such a high share price. SPY, at the time I'm recording this video, is trading nearly $580 per share. That's a very high priced underlying stock. Most people can't afford selling naked options in that. Also, if you could sell a naked option in that, the buying power requirement on those naked options would be extremely high. So the next best bullish strategy, I think, on SPY is selling put credit spreads, which is essentially selling a short put, but also combining it with buying a lower priced long put. And when you sell a put and buy a lower price put, that creates a put credit spread. That's a defined risk trade. And because it's a defined risk trade, our buying power requirement on that trade is going to be drastically lower than just selling a short put. Because if you want to sell short puts, naked puts in SPY, you have to have a very large account. You have to have a very high net lick account value to constantly trade short puts in SPY. But with put credit spreads, because they're a defined risk trade, they're much lower as far as buying power requirement. Any size trading account can do a put credit spread campaign in SPY. So what is a put credit spread? Let's take a look at the risk profile. So a put credit spread is where you sell usually an out of the money put. So, this is where the stock is currently trading. We're going to go down a little bit lower and sell a put. And then below the short put, we're also going to buy a put. And buying this put caps our loss because typically a short naked put would have unlimited losses to the downside. You could theoretically lose unlimited amounts of money to the downside, but buying this extra put caps the loss right there. So this is a limited risk, limited reward kind of trade. So what is our max reward? Well, when you sell a put credit spread, you're selling it, meaning you receive a credit. The max reward on the trade is the credit you received when you sell the put credit spread. And as long as the trade finishes at expiration above the short put, that is the max reward. And the max reward, again, is the credit received. Now, what is the max loss? Well, the max loss is the width between the spreads minus the credit received. So if we're doing $5 wide credit spreads here, meaning there's $5 in between the long put and the short put, and let's imagine you receive $1 credit for selling the put credit spread. Well, what's your max loss? Well, that would be $4. $5 the width of the spread, minus the $1 credit received, your max loss in this case would be $4 on that example trade. Ideally, you want to sell put credit spreads when IVR is high, but when we're doing our put credit spread campaign, we're not really going to focus very much on IVR, because when you're campaign trading is a type of trading based on a specific plan. You come up with a specific game plan, a strategy based on delta and DTE and probability of profit and risk versus reward and whatever. You come up with your specific plan, and it's based on a specific interval of time, meaning we're going to make this trade every week, or every 2 weeks, or every month. And we're always going to stick to that time frame. We're never going to deviate. Now, one thing we need to make sure of, we need to make sure that anytime we're running a trading campaign, that our strategy has a positive expectancy. In other words, we need to make sure we're using a strategy that has a small edge, that if you trade it enough times, you're guaranteed to make money in the long run. Thus, really the purpose of campaign trading is to turn a small amount of money into a vast sum of money by trading hundreds or even thousands of occurrences over a number of years. So campaign trading is not something you do for the short term. It's not something, I'm going to sell put credit spreads in SPY every week for the next month, the next 6 months, the next year even. Typically, because we know it has a positive expectancy, if you have a whole bunch of occurrences, we're talking about, again, hundreds of occurrences, or even better, thousands of occurrences, you run a campaign for typically a number of years, sometimes even a decade or more. After all, when you know a trade has a positive expectancy, why wouldn't you do it all the time, right? It's practically free money. As long as you manage your risk properly, it's practically free money. So campaign trading, it really just becomes part of your daily or weekly or monthly routine, depending on, again, how often you're putting on your new trades, whatever time frame you're using for your campaigns. So let's discuss the plan. So this is the parameters we're using over in the DT Options Discord server for our put credit spread campaign on SPY. This is the parameters we're using. First up, delta. We sell the 35 delta put, and then we buy a long put 5 points below. So we're doing a $5 wide put credit spread, and using the 35 delta short put and the $5 wide spread, typically what you're going to do is you're going to receive a credit of somewhere around $1 to maybe $1.25. You need to make sure you receive at least $1. I really don't want to receive less than $1 on the trade as far as a credit. If I receive less than $1, then maybe I bump it up to like a 36 delta, 37 delta, we'll adjust it a little bit, but typically you'll receive somewhere between $1 and $1.25. That is your max reward, because that is the credit received on the trade, and the max reward on a put credit spread is always the credit received for selling the spread. Now, what is the max loss? Well, again, the max loss is the width of the spread. Remember, it's a $5 wide spread, so $5 minus, say, 125 credit received. So what's the max possible loss? The max possible loss is going to be around $3.75. So we're going to risk essentially $375 on the trade to make about $125. For days to expiration, we're going to place these trades at 60 DTE, and then we're going to manage the trade at either 50% of max profit or at 21 DTE. So we sell our put credit spread at 60 DTE, and if we hit 50% of max profit, we close the trade. If we don't hit 50% of max profit at 21 DTE, we're closing the trade no matter what. So whichever one comes first, 50% of max profit or 21 DTE, that's when the trade comes off. Now, IVR, we've already talked about, put credit spreads. Typically, you want to sell them when IVR is high, but because this is campaign trading and we're sticking to specific intervals of time, we're really going to just ignore SPY's IVR, even though we'd like SPY to have high IVR when we sell put credit spreads in it. Because we're campaigning it, we really can't do much about it. But, it is certainly reasonable for those of you that want to modify this plan. If you want to modify the plan to where maybe you trade more spreads or maybe wider spreads when IVR is elevated, which, theoretically should increase your P&L a little bit, that's perfectly okay if you want to modify the plan based on IVR. So let's talk about the back test. So I back tested this, even though I kind of know put credit spreads in SPY, they're practically guaranteed to work. It's a bullish strategy. SPY just tends to go up, but still we needed to back test this thing just to make sure that the numbers make sense. So I did a back test on Tasty Live's look back tool, and I did a 10-year back test. I didn't want to go back too far back in time, because if you go back more than 10 years, SPY was trading at such a low price. Some of the numbers, get a little weird, but I did a 10-year back test, and you can see I sold the 35 delta put at 60 DTE. And then because it doesn't have the option of me specifying going $5 wide on the spread, I had to choose a delta. I chose 30 deltas. That probably equates to around $5 in most cases, maybe $4 to $7, somewhere in the general area. And then we're also going to exit early at 21 DTE, or we're going to exit early at 50% of max profit. And when you run that back test, these are the results. Now, these results are crazy good. And the reason they're crazy good, well, let's start with the win rate. We win 90% of the time. Now let's go back a slide. What were our deltas? We sold the 35 delta short put and bought the 30 delta long put, but we sold the 35 delta short put. What do you think the win rate on a 35 delta short put should be theoretically? Well, we should win about 65% of the time. We should lose about 35% of the time, right? That's kind of what you think. With some positive drift to SPY, you might think that 35 delta put might win 75% of the time. But look, we're winning on this spread 90% of the time. That is crazy good. You can see our largest profit was $685. Now, some of these spreads could get very expensive depending on the volatility that was going on. May of 2022 was a very bearish kind of time, and the largest loss here was $1,100. That was also in 2022. And probably what was going on is because I couldn't, in the back test, choose a specific like $5 wide spread. I chose 35 delta for the short, 30 delta for the long. Those got really wide in some instances to where the actual size of the spread was very big. It was probably like a $10, $15 wide spread in some cases, and that particular very large spread ended up losing. That's what the largest loss is. So this largest loss is not a loss we would ever take in real life, because we're going to stick to being $5 wide. And then you can see the numbers here for the average premium collected on each trade, the profit per trade, the days per trade, and the profit per day. Now, these numbers are going to be small because it's a 10-year back test. Remember, I went all the way back to January of 2015, and January of 2015, I don't know what SPY was trading at, but it was probably trading at $200 a share. SPY is nearly $600 a share now. So when we're putting on these trades now with SPY's pricing today, these numbers are going to be quite a bit bigger. I would expect our profit per trade to be probably closer to like $50, per trade. Days in trade, though, should be about the same. So we put these on at 60 DTE, and we're taking these off on average in 20 days. Meaning that 90% of the time these things win, and most of the time they win so fast that our average time in the trade, our average days in the trade is only 20 days. Again, that's an exceptionally good number. So let me switch over to the trading platform that I use, which of course is TASTYTRADE, and let me show you an example trade. So typically I would go to 60 DTE, and what we've been doing here is every couple of weeks on Monday we put these on. They typically would be exactly 60 DTE. Right now, there's no expiration that is exactly 60 DTE. I'm actually recording this on a weekend, but I'll go to 69 DTE for this example. And the way this works is I've got the time frame, the 60 DTE. Now the deltas, remember, I'm going to sell the 35 delta put and then go $5 wide for the long put. And then max profit in this case is 104. Max loss is 396. So I'm okay with that risk versus reward there. And essentially that's it. I would go ahead and send that trade. And then I've already got an example of a SPY put credit spread that I've had on for nearly 20 days here. It is already a 33% winner or so. But remember, we're going to either manage it at 21 days. Right now it's at 34 DTE. So I've still got time before 21 days, or we're going to manage it at 50% of max profit, which I can go ahead and put a 50% take profit order on. Let me go ahead and put that on. And now I'll just have this working order sitting here for the life of the trade. If I ever hit 50% of max profit on the trade, that gets filled. And, I close it for a winner. And if I never get filled for 50% max profit at 21 DTE, I'm going to take the trade off regardless, whether it's a winner, whether it's a loser. At 21 DTE, I'm going to take it off. And the reason I'm taking it off at 21 DTE is just to avoid a lot of delta risk and gamma risk, as well as assignment risk. If you hold this all the way to expiration, you could be in a weird situation where SPY finishes in between your short strike and your long strike. One side of the trade gets exercised, but the other side doesn't. And, you avoid all of that unnecessary heartache and pain. So let's talk a little bit more about the risk of our put credit spread campaign. So ideally, I would say you don't want to risk any more than 1% of your total net lick account value on each trade. And this is pretty much for all defined risk trades. I don't want to risk more than 1% of my account on any kind of spread trade. So for example, let's imagine I have a $100,000 trading account. What is the most I want to risk on any one trade? The most I want to risk is $1,000, right? Because if I have a $100,000 account and I lose $1,000 on a trade, well, that's not that big a deal, right? But if I risk 5% of my account, that's a big deal, taking a $5,000 loss on a $100,000 account. That hurts. That hurts a lot. So really, 1% is perfectly okay. I think that's a good conservative number. Also, if you're a little more conservative, or maybe you just have a small trading account and you don't want to risk too much of your overall account value, then what you want to do is you want to open up your new trades at 60 DTE every other week. So you're putting on a new put credit spread every 2 weeks. What this means is, because you're managing your trades at 21 DTE, they're always coming off at 21 DTE no matter what. The most possible trades you could have on at any one time of these put credit spreads, the most you'll ever have on is 3. And that's assuming that they don't hit 50% of max profit. And the reason is you put on that first put credit spread at 60 DTE. You wait 2 weeks, and then you put on the second one. Now you have 2 on. Then you wait 2 weeks, and you put on the third one. And that's assume that none of them hit 50% max profit. So you now have 3 on at one time. And then the next time 2 weeks passes, well, that's past the 21 DTE mark for one of the trades, so one would drop off when you put on the next. So you'll never have more than 3 trades on at a time, as long as you're managing at 21 DTE. So that's the conservative approach. If you want to be a little bit more aggressive, or maybe you have a larger trading account where you can afford to put on a lot more of these, then what you want to do is you want to open a new trade at 60 DTE every week, every single week. And this means that you could possibly have on as many as 6 trades on at any one time. Now remember, in our back testing, the average days in the trade, according to the back test, was only 20 days. So that's about 3 weeks, a little under 3 weeks. So it should be kind of rare to ever reach that max number of trades, but it could happen. And because it could happen, you need to make sure that you're comfortable trading that max number of trades. So if you're doing every week, you need to make sure, hey, if I have 6 of these trades on, imagine I have 6 of them on, and let's imagine all 6 lose. Could I take that loss? Would I be comfortable potentially taking that loss on the max number of trades? If the answer is yes, do it. If the answer is no, then what you need to do is you need to reduce the trading interval. So instead of trading every week, trade every other week, and that's going to reduce the overall number of trades you'll put on. It'll also reduce the max number of trades you'll ever have on at one time. Again, because now if you couldn't afford to lose on potentially 6 trades at one time, could you afford to lose on 3 trades at one time? If the answer is yes, then do the every other week campaign instead. Or if that's a problem for you, you could do once a month. I mean, you pick the time frame and the interval that works for you. This is my plan, what I'm running in the DT Options Discord server, but this is just an example plan. You could modify this plan to make it your own, and honestly, I think that's what you should do. So there you have it, our put credit spread campaign plan that we're running over in the DT Options Discord server. Put credit spreads on SPY. They just work. Now, if you want to learn more about options trading, including my favorite option strategy, which is the wheel option strategy, check out my book, The Super Wheel Option Strategy, available on Amazon. You'll find a link to this book in the description below. Also, if you want to help support the channel, please consider subscribing to the DT Options Discord server. I hang out for the first hour of each and every trading day in the DT Options Discord. We discuss what the market's doing. You guys get to see what I'm trading. I want to hear about what you're trading. And of course, we discuss things like this put credit spread campaign and SPY. Peace, guys.